Hey everybody, good weekend. Welcome to the Market Minute for Sunday, the 21st of May. Here's the daily chart of the S&P 500, and as we all know, by this point, what's dominating the conversation is the debt ceiling debate. We go through this every couple of years or so. They wait till the very last minute. A lot of uncertainty comes around this, and then eventually they end up hiking the debt ceiling, almost raising the credit card limit. So as we know, there's going to be a massive amount of political brinksmanship up until the very last minute because there's honestly a lot up for debate. Do we just rubber stamp this thing, or do we use this opportunity to create some meaningful change? So anyway, on the chart right now, a lot of this depends on whether or not they go ahead and okay the new ceiling. And if so, I think we may end up popping to the upside, at least temporarily, but I've not been convinced of the ability of this market to sustain any kind of a breakout from a consolidation. That has been the biggest issue and the one thing that's prevented me from going full bull on this. Now, the NASDAQ, on the other hand, has actually been doing exactly that. So if we go out to the NDX, you can see that we've had consolidations, and this is a clear breakout. Good, strong breakout to the upside based on a consolidation. Now, even the NASDAQ was not doing this before. We consolidate, and then it would break to the downside. We consolidate, and then it would break to the downside. But for the very first time in the last year and a half, we now have an upside breakout, especially a parabolic move here where the rest of the market is chasing after the NASDAQ. But back to the S&P, we do not have that yet. So even Friday's small little reversal candle shows that we still have a ways yet to go before the S&P, the full S&P, can support a breakout to the upside. So here's the deal for this week. If we actually do close above 4,200, then we have to believe that, right? We have to believe that at face value, especially if it's on a good, strong candle of volume. But if it's one of these types of candles, then I'm inclined not to believe it, and I would expect to see the price fall back down, maybe as far down as 4,000. So again, to me, I think this would actually be the better long-term solution, because if the price falls down to here, we're going to build up that negativity to an amazing amount, and that's going to set the stage for what I believe will be an even stronger rebound. This is how this market has been working for the past, well, year and a half or so. Is for us to go higher, we have to go lower first. For us to go higher, we have to go lower first. Very similar to what happened back here in December. For us to go higher, we had to go lower first. And I think this will be much the same, especially if this drags on all the way into the holiday weekend. I think we could end up back down near 4,000 by that time before the next big slingshot move happens. Now, zooming out for a second, even if we do get that pullback down to 4,000 and an eventual slingshot from that point, there's no guarantees that this will head to higher highs above 4,800. In fact, a very real possibility might be that this whole thing turns into a bull trap, unfortunately, because we do have so many headwinds into the end of this year, especially with the way that fewer and fewer stocks are actually breaking higher to support these prices. So we have this market basically, which is standing on the stilts of just a few very, very large tech companies. And it's similar to what we saw back here in 2021. So I'm getting ahead of myself now. So one thing at a time. We'll see if we can break above 4,200 on the full S&Ps. And if not, I would expect to see a revisitation of the 4,000 level, perhaps by the end of this week. 200 points can go by in a blink of an eye in today's market. All right, that is it for today's Market Minute. Thanks for listening, and we'll see you in the next one.